founded Tesla Motors in San Carlos, California, with a mission to revolutionize transportation through sustainable electric vehicles, EVs. Contrary to popular belief, Elon Musk was not an original founder, though his later involvement shaped Tesla's narrative. The company's name pays homage to Nikola Tesla, the inventor of the alternating current (AC) electrical system, symbolizing their commitment to electrical innovation. Eberhard and Tarpenning crafted an ambitious business plan rooted in a two-phase approach: launch a premium electric sports car to establish brand credibility and technological prowess, then transition to affordable mass-market models. This strategic blueprint, born from their vision of a fossil, fuel-free future, laid the foundation for Tesla's eventual billion-dollar strategies and global dominance. Early vision and challenges. The duo started with limited resources, leveraging their experience in technology, Eberhard from Nuva Media, book pioneer, and Tarpenning from software development. Their initial focus was on proving EVs could compete with gasoline cars in performance and appeal, a radical idea at a time when hybrids like the Toyota Prius dominated the green car market. They faced skepticism from investors and automakers, who viewed EVs as niche and impractical due to battery limitations and high costs. Early funding. In Musk's entry in February 2004, Elon Musk led Tesla's series of funding round, injecting $6.5 million of the $7.5 million raised, securing a 35% stake in the chairman role. Eberhard remained CEO and Tarpenning served as CFO, driving early product development. Musk's financial backing and entrepreneurial reputation from PayPal and SpaceX attracted further investment, but his influence grew rapidly. By 2008, internal conflicts over management style and strategic direction led to Eberhard's demotion and exit in 2007, with Musk taking the CEO helm. This transition marked a pivotal shift, as Musk's bold vision, amplified by media hype, redefined Tesla's trajectory. However, the original Roadster's lithium-ion battery technology and business model were Eberhard and Tarpenning's brainchild, a point often overshadowed by Musk's prominence. First product. The Roadster, Tesla's debut vehicle, the Roadster 2008-2012, was a game-changer. Built on a modified Lotus Elise chassis, it was the first highway-legal serial production EV to use lithium-ion batteries, offering a range of over 200 miles per charge and a Yo-60 MUF acceleration in under 4 seconds. Priced at approximately $100,000, only 250 units were sold globally, generating about $245 million in revenue. Despite modest sales, the Roadster established Tesla as a pioneer, proving EVs could be luxurious, high-performance, and environmentally friendly. The car's success hinged on a partnership with Lotus and battery supplier Panasonic, highlighting Tesla's early reliance on external expertise before its in-house innovation push. Tesla's billion-dollar strategies. The exposé playbook. Tesla's ascent to $1 trillion valuation by 2025 stems from a series of innovative yet risky strategies that propelled it from a fledgling startup to a corporate giant. These billion-dollar strategies align perfectly with the big money blueprint theme of dissecting the financial blueprints of industry titans. Each strategy involved significant capital outlays, external support, and bold gambles, offering a rich narrative for your channel's audience. Premium to mass market transition strategy. Tesla's initial strategy, devised by Eberhard and Tarpenning, was to enter the market with a luxury EV, the Roadster, to fund research and development R&D while building brand prestige. This was followed by the Model S sedan 2012, an all-electric luxury car with a 2x 65-mile range, and the Model X SUV 2015, featuring Falcon Wing doors. The pivotal move came with the Model 3 2017, priced at $35,000 to target the mass market, and the Model Y 2020, a compact SUV. This phased approach allowed Tesla to refine technology and manufacturing processes while scaling production. Financial impact. The Model S became the best-selling plug-in EV globally in 2015 and 2016, with cumulative sales exceeding 250,000 by 2018, generating substantial revenue and brand equity. The Model 3, despite production bottlenecks, stub manufacturing held by Musk, sold over 1.8 million units by 2023, driving 94% of Tesla's $67 billion revenue that year. However, revenue dropped from 2022 to $107 billion in 2023 due to aggressive price cuts to boost demand amid competition, reduced gross profit to $16.52 billion from $20.85 billion. The Model Y launched later added another 1.2 million units by 2023, solidifying Tesla's market lead. Critical view. While the premium to mass transition built a loyal customer base, it delayed Tesla's mass market dominance. Competitors like Volkswagen with the ID series and GMC with the Bolt gained ground during Model 3 delays, which cost Tesla $3 billion in operational losses from 2015-2018. The focus on luxury initially catered to wealthy buyers, potentially alienating the broader market Tesla later targeted, and production inefficiencies exposed vulnerabilities in scaling. Vertical integration and in-house innovation strategy. Unlike traditional automakers reliant on a network of suppliers, Tesla opted for vertical integration, designing and manufacturing most components in-house, including batteries, motors, and software. This began with the acquisition of the NEMI plant in Fremont, California, from Toyota for $42 million in 2010, transforming it into the Tesla factory. Tesla also invested heavily in battery technology, developing 4 cell types, 18650, 2170, 4680, prismatic, and partnering with KLG and Panasonic for production at its gigafactories in Nevada, Shanghai, Financial impact. This approach reduced cost and dependency but demanded massive capital. In late 2024, Tesla's capital expenditures reached $6.3 billion, yet asset growth was only $4.9 billion, leaving a $1.4 billion gap. Analysts suggest this discrepancy stems from foreign exchange fluctuations, e.g., the weakening euro impacting German assets rather than mismanagement. Tesla's $36.5 billion cash reserve in 2025, bolstered by $19 billion raised since its 2010 IPO, funds ambitious projects like AI and the Cybertruck, though it avoids dividends. Critical view. Vertical integration offers strategic control but strains finances significantly. Tesla's $9 billion negative cash flow since 2010, despite raising $19 billion, raises sustainability concerns. The $1.4 billion capex gap has sparked debate, with some ex-posts in 2025 questioning Tesla's accounting transparency. The lack of dividends, while typical for growth companies, frustrates investors seeking returns, especially as Tesla stock volatility increases. Charging infrastructure investment strategy. Tesla pioneered a global supercharger network to address EV range anxiety, a key barrier to adoption. Launched in 2012 with the first stations in California, the network expanded to 1,359 locations worldwide by 2024, including showrooms and service centers, with plans for 2,000 by 2026. This infrastructure supports Tesla's travel and enhances Tesla's brand as an EV leader. Financial impact. The supercharger network underpins Tesla's 46.7% U.S. revenue share and 22.5% from China in 2023, despite a 5% delivery drop in Q2 2024. It also generates ancillary revenue through electricity sales and maintenance services, though exact figures are bundled into Tesla's $96.7 billion revenue. The network's expansion costs billions, offset by government incentives and customer loyalty. Critical view. The supercharger network is a competitive moat, but its capital intensity is a double-edged sword. Competitors like Electrify America and ChargePoint are building rival networks, and Tesla's decision to open some stations to other brands in 2024 dilutes its exclusivity. As EV adoption grows, this first-mover advantage may wane unless Tesla innovates further, such as with ultra-fast 350 kW chargers. Government subsidies and regulatory credits strategy. Tesla capitalized on government support to fuel its growth. In 2009, it secured a $465 million loan from the U.S. Department of Energy under the Advanced Technology Vehicles Manufacturing Program, repaid with $12 million interest by 2015. Tesla, SolarCity, and SpaceX collectively received $4.9 billion in subsidies. In March 2025, Tesla exploited Canada's EV incentive program, selling 653 vehicles in 72 hours, netting $43 million before the program's cap was hit, a move some called strategic gaming. Financial impact. Subsidies were lifeline during lean years like 2008, when Tesla burned $4 million monthly and was weeks from bankruptcy. Regulatory credits, where Tesla sells excess zero-emission credits to other automakers, added $1.8 billion to its 2023 revenue. This financial cushion enabled risky bets like the Model 3 launch and Gigafactory investments. Critical view. Critics argue this reliance on public funds is inequitable, favoring wealthy buyers, e.g. Model S owners, over average consumers. In Canada, the $115 million cost to taxpayers for a 94-mile range Model 3, with only 26 sold versus 12,000 higher-end models, highlights profit prioritization. Ex-post in 2025 call Musk's 2008 funding scramble a near-illegal lifeline, questioning the ethics of such maneuvers. Autonomy and AI ambition strategy. Tesla bet on full-festive technology and artificial intelligence. AI aims to redefine transportation with Robotaxis and the Optimus humanoid robot. Musk's 2019 claim of 1 million Robotaxis by 2020, followed by a $3 billion stock sale. FSD, priced at $15,000 in 2022, became an upsell option, boosting margins, though the technology remains level 2 FOSS part automation per se standards. Financial impact. FSD sales contributed to profit margins, with Tesla reporting $1 billion profit in Q1 2024 despite an 8.5% sales drop. However, a 2020 California DMV filing showed no significant autonomy enhancements expected. From next generation gigacasting to self-driving reflects market pressure. Tesla's AI focus, including the Dojo supercomputer, consumed $2 billion in R&D in 2024. Critical view. Musk's autonomy hype has drawn scrutiny. Videos from 2021 show SD beta failures prompting NHTSA investigations into 12 crashes. The initial NDA for beta testers was seen as a cover-up, and a 2025 Reuters report noted Chinese consumers' disappointment with the Navigate on City Streets feature. Analysts question whether Tesla's AI investment will yield returns before competitors like Waymo overtake it. Diversification into energy and solar strategy. Tesla expanded into energy storage and solar through Tesla Energy, acquiring SolarCity in 2016 for $2.6 billion. A deal criticized as a bailout for Musk's cousin Peter Rive's struggling company. Products include solar panels, the solar roof, Powerwall's home battery, and Megapack grid-scale storage targeting renewable energy future. Financial impact. In 2023, 7 GW of storage up 25% from 2022, but only 223 MW of solar down 36%, reflecting uneven growth. Energy accounted for 6.2% of $96.7 billion revenue, with a $1.9 million gross profit, dwarfed by automotive's $16.52 billion. The Giga New York factory, built with $1 billion in NY state funds, aimed for 500 jobs but delivered fewer, drawing criticism. Critical view. Energy diversification is a long play but contributes minimally to revenue, 79% from autos in 2024. The SolarCity acquisition added $3 billion in debt, partly due to supply chain issues in 2022. Highlight execution risks. Taxpayer-funded projects like this raise questions about Tesla's accountability. Recent developments 2024-2025 financial struggles. Tesla's profitability fell to $1.1 billion in Q1 2024 with revenue dropping 9% to $20.3 billion due to an 8.5% sales decline. Price cuts to maintain market share reduced operating margins to 5.5% from 9.6% in 2022. The 1,000-employee layoff 10% of workforce hit in April 2024. By February 2025, Tesla's market cap fell below $1 trillion, a 20% drop in 2025, driven by European sales declines 15% in Germany and Musk's political distractions with Trump's administration where he advises on deregulation. Stock and insider moves. Insider selling intensified in early 2025. Kimball Musk sold 75,000 shares in February, and James Murdoch offloaded 50,000, signaling caution. Musk's $56 billion pay package approved by shareholders in 2024 amid a Delaware court challenge faces revaluation by a board committee in May 2025, with critics arguing it rewards underperformance given the stock's 30% decline. Protests and vandalism. Tesla faced backlash in 2025 over Musk's political ties. In April, a UK activist group smashed a Tesla window in London, and the FBI reported isolated attacks, arson at a Shanghai store and gunfire at a Texas facility. Though Musk's claim of billionaire orchestrated sabotage lacks evidence, these incidents, covered on X, hurt Tesla's brand image. New products. The Robo-van unveiled in October 2024 is an autonomous 20-passenger van targeting fleet markets, while the Model 3 Performance, launched in 2024, uses advanced manufacturing for a ZUA 60 mph time of 3.1 seconds. However, Tesla scrapped next-gen gigacasting plans in May 2024 to prioritize self-driving tech, a move analysts see as a pivot under pressure. Market position. As of April 2025, Tesla's market cap stands at $790 billion, the largest among automakers, but its 1.8 million annual deliveries lag behind Toyota's 10.5 million. Competitors like Volkswagen $17.1 billion R&D and GM $13.5 billion outspend Tesla $11.4 billion, threatening its tech lead as EV subsidies wane.